Signs that the wall of worry that hit tech stocks in 2022 may slowly be coming down. Climbing interest rates, profitability, dollar strength, those were some of the factors that hit the complex hard last year. Now, however, investors seeing light at the end of the tunnel. The Federal Reserve is thought to be near the end of its rate hike cycle amid softening inflation, unprofitable tech companies. In many cases, they're narrowing losses, and the dollar index is trading near 15-month lows. That is a positive for tech companies that generate more than 50% of their revenue abroad. That's the highest share among all S&P 500 sectors. When the dollar's stronger, sales earned overseas in non-dollar currencies, they're worth less. So the opposite is also true. When the dollar weakens, those sales are worth more. So in 2022, amid dollar strength, billions were wiped off quarterly earnings of U.S. companies. Will the weaker dollar now be a boon this season, or is it already baked in? Let's talk to Jeremy Schwartz, Wisdom Tree CIO. Jeremy, what do you think? Does the dollar matter the same way it did back in 2022 when you had other factors at play? We spent the first part of the show talking about this huge secular shift in artificial intelligence that investors now seem to be focused on.
I was worried I was going to have to explain the impact, but you did a beautiful job there explaining exactly what's going on. And, you know, I do think last quarter was perhaps the peak of the hit that the tech companies were taking from the dollar. If you go back last year, there was a 6-month period where the dollar was up 15%, and that was a huge move. And that was a drag, I think, on the first quarter earnings. I think as you get later this year, it turns into a tailwind instead of a headwind. I think this quarter, it's a modest tailwind perhaps, but I think later in the year, as these sort of lower dollar figures average into their sales and their profits, I think it becomes a much bigger boost to their earnings.
Jeremy, we saw even some dollar strength this week coming off a low base, but the NASDAQ also underperformed. Do you think that that's correlated?
You know, these very short-term moves, it's always very tough to pinpoint an exact reason why things are moving. I do think I've said the dollar has been one of the better hedges to things like the S&P 500 because so much more of our earnings are coming abroad, and you hit it exactly that the tech sector is the sector with the most earnings from abroad. So, you know, you could say they are extra hit. I do think the dollar serves an interesting role in portfolios to diversify this earnings. A lot of people take currency risk when they go overseas, where I say the dollar is the better diversifier because of that inverse correlation between earnings and the dollar. But on the very short-term moves, it's hard to say any single factor is the key driver.
Let's talk a little bit more broadly, because the question we're constantly asking here, many investors are asking, is are we back in bubble territory after this downturn? And you hear a lot of talk about the dot-com bubble and how valuations became so inflated. We did our own research on this, and I'm sure looked at many of the things you look at, bigger cash piles, more profitability this time around. But you think we're only halfway to those multiples. Why?
Oh, you picked that up in my Twitter thread. I did say...
We're watching. Our producers always watching.
If you go to the forward PE ratios, back in 2000, the forward PEs of the tech sector, which is now 40% of the market, the expanded tech sector. This includes like Amazon and Meta, who were reclassified out of tech to communications services and consumer discretionary. They were in the 60s on a forward P basis back in 2000. We're today at 30. And so it's when people say that the relative performance, yes, some of the outperformance of the NASDAQ and others look like February 2000 versus small caps, but the PEs, the multiples, these companies are making more money. And so I think it's half the multiple of where it was back in 2000.
Yeah, and for that reason, you know, we call companies like Apple nation states, and the mega caps are being treated like defense stocks. Do you think that that's accurate? Do you think that investors should be treating them as such?
They do have these pristine balance sheets and all these quality indexes. We launched a quality growth index that includes all these magnificent 7 stocks that you're seeing. And because we're looking at profitability, low balance sheet leverage, low debt, they are very cash rich, as you said. So there's a lot of reasons to say these are very good borrowers. When they're borrowing, they can pay back their debt. And so some people thought during the crisis, hey, you want to be with tech companies more so than governments. And there's something to that. But so I do think these companies are very high profitability, very high quality companies.